When traders hear that the Federal Reserve is holding a policy meeting on September 16, 2025, the natural reaction is to view it as another routine gathering, a moment where policymakers sit down to discuss interest rates, inflation, and economic stability. But when you are operating in the markets with a trading mindset, you recognize that these dates are not routine. They are potential catalysts that can ignite volatility across multiple asset classes. Every Fed meeting has significance, but some stand out as defining moments, and this one belongs in that category. Why is that? Because by mid-September 2025, the US economy will have been walking a fine line. Inflation data, unemployment reports, and GDP growth figures will have painted a picture of fragility mixed with resilience. Traders know that the Fed's hand is often forced not by abstract policy goals, but by the immediate pressures visible in the market. A small shift in rates can transform credit markets, reprice equities, and change global flows of capital. The simple calendar mark of September 17 therefore becomes a battlefield where every trader, hedge fund, and institution positions themselves for what comes next. The trading mindset doesn't see this event as a headline. It sees it as an opportunity to measure imbalance. Liquidity pockets expand and contract before such meetings, because major participants anticipate the shock that could emerge from even a single phrase in Powell's remarks. Retail traders often underestimate the power of these meetings, thinking the action begins on the announcement day itself. In reality, the smart money begins positioning weeks before, and the charts tell the story. You start to notice unusual volume in Treasury futures, options chains lighting up at specific strike levels, and sectors within equities gaining or losing momentum in patterns that do not line up with normal macro flows. Consider how markets behave in anticipation of a potential cut. If the Fed signals that rates may be slashed, bond yields move first, not after. The bond desks of major banks begin absorbing treasuries, pushing yields lower before retail even catches on. Equities, particularly rate-sensitive sectors like housing and tech, start to attract speculative flows. Meanwhile, the dollar weakens as currency desks hedge against lower U.S. interest rate differentials. To the untrained eye, these are fragmented moves, but the trading mindset stitches them together, realizing they are part of the larger puzzle leading up to the Fed's decision. The September 2025 meeting also holds symbolic weight because it lands in a historically volatile period. The third quarter often reveals hidden cracks in the system. Corporate earnings begin to expose which companies can withstand higher borrowing costs and which ones cannot. Hedge funds and pension funds start rebalancing ahead of the final quarter of the year, aligning their exposures to fiscal expectations. When you add the possibility of a rate cut or even the hint of one, you create the perfect storm where liquidity can vanish in seconds and market depth becomes shallow enough for violent price swings. Traders must therefore think about this meeting as more than an isolated event. It is the intersection of monetary policy and market psychology. Each statement from the Fed carries with it a layer of ambiguity. Because central bankers rarely speak in absolute, they prefer phrases like data-dependent, closely monitoring, and forward guidance, all of which create room for interpretation. That ambiguity is not a flaw. It is the spark that fuels volatility. For traders, ambiguity equals opportunity. If you can interpret the market's reaction faster than the majority, you place yourself on the profitable side of the move. Another aspect that amplifies the significance of September 16-17 is global positioning. The Fed does not operate in a vacuum. Central banks across Europe and Asia track the Fed's decisions like hawks. A rate cut in the US could trigger policy responses abroad, shift capital into emerging markets, and alter commodity demand expectations. Oil, gold, and even agricultural futures will not remain unaffected. For a trader, this means your focus cannot be narrow. You cannot afford to look at only one chart or one sector. The trading mindset demands a panoramic view, connecting the dots across equities, bonds, currencies, and commodities. Market participants also understand that such events are magnets for retail speculation. The moment headlines flash across financial terminals, retail traders rush in with emotional decisions, often chasing the initial move. Big players know this pattern well and often exploit it by engineering fakeouts. A dovish signal might spark a surge in equities, only for institutions to sell into that strength, leaving latecomers trapped. A hawkish tone could cause a sharp drop, but smart money may step in to accumulate positions at discounted levels. The September meeting, therefore, is not just about the Fed's decision. It is about how institutions weaponize that decision against uninformed traders. As the dates approach, the anticipation itself becomes part of the trade. Volatility premiums rise, option spreads widen, and liquidity becomes uneven. Traders who understand this dynamic prepare not only for the day of the decision, but for the run-up and aftermath. The meeting creates a timeline of opportunities, weeks of positioning, days of tightening, minutes of reaction, and hours of recalibration. For those who approach the market with discipline, this timeline is a roadmap. For those who treat it as a gamble, it becomes a trap. This is why the September 16-17, 2025 meeting is not just a policy event. It is the event that shapes the market, the pivot point where discipline, preparation, and the ability to read the flow will separate the traders who survive from the traders who are consumed. When traders hear about a major Federal Reserve decision on the horizon, the natural instinct is to think that the big moves will occur right when the announcement is made. But in reality, the market does not wait for Powell to step up to the microphone. The market is already in motion, and the most powerful players have been setting up their positions long before the retail crowd even realizes what's happening. Institutions, hedge funds, sovereign wealth funds, and market-making giants begin their maneuvers weeks, sometimes months, before a key Fed meeting. This is the difference between trading with the masses and trading like the pros. The trading mindset recognizes this reality. Nothing in markets happens in isolation, and the footprints of institutional players are rarely invisible. They appear in the options chains, in unusual block trades, in sector rotations, and in the subtle changes of liquidity across asset classes. If the September 16-17, 2025 meeting carries even the smallest chance of a rate cut, the big players are already laying traps, hedging risk, and aligning their portfolios. What seems like random noise to the untrained eye is actually calculated preparation. Think about how they operate. A large institution does not have the luxury of entering or exiting positions in one swift move without moving the market against itself. Their size makes them visible. To avoid detection, they spread trades over days, even weeks, using algorithms and dark pools to disguise their true intentions. They may accumulate rate-sensitive stocks in small increments, disguise bond buying under the cover of index rebalancing, or use options to mask directional bets. To the retail trader, this activity looks like scattered volatility. To the trained trader, it is the signature of the big players positioning themselves for what they believe is coming. The positioning is not always directional. Hedge funds, for instance, thrive on relative value plays. They might not know with certainty whether the Fed will cut, hold, or hike, but they will align spreads in ways that profit from the volatility itself. That could mean long volatility straddles, calendar spreads timed precisely around September expiration dates, or pairs trading between assets that react differently to interest rate changes. By structuring these plays early, they lock in advantageous prices before the rush of retail traders drives premiums higher. The market becomes tilted not because of the Fed's decision itself, but because of how these major players anticipate and prepare for it. Bond desks, in particular, are masters of early positioning. Every move in the Fed funds rate directly impacts Treasury yields, and institutions know the yield curve is a battlefield where fortunes can be made or lost. If they expect even a whisper of a cut, they begin absorbing long-duration Treasuries quietly, pushing yields lower ahead of the event. These shifts may seem minor at first, a few basis points here or there, but they are signals that liquidity is being redirected. For those who watch closely, these are the breadcrumbs leading back to the strategies of the largest market participants. Equities tell a similar story, though in a more fragmented way. Not every sector reacts the same to rate expectations. Tech stocks, with their dependence on future cash flows, thrive on lower rates. Banks, conversely, can suffer from compressed net interest margins. Institutions know this, and they rotate capital accordingly. When you see tech indices gaining strength while financials lag, you must ask, is this simply random earnings rotation, or is it the early repositioning ahead of a rate decision? The trading mindset leans toward the latter, because patterns like these rarely emerge in a vacuum. Currency markets are also early battlegrounds. The dollar is highly sensitive to interest rate differentials, and big players begin shifting exposure before the Fed meeting even takes place. Sovereign funds, multinational corporations, and central banks abroad hedge their dollar exposure in anticipation. That creates volatility in forex pairs well before the Fed speaks. Retail traders often get whipsawed here, chasing breakouts that appear sudden but are in fact engineered flows. Watching the dollar index and its correlation to bond yields becomes a critical tool for anyone attempting to track how institutions are moving. What traders must understand is that none of this is guesswork. Big players rely on vast networks of data, internal economists, and forward-looking indicators. They know how to read the labor market reports, inflation data, and housing statistics, not as isolated pieces of news, but as threads woven into the Fed's likely mindset. They don't wait for the official decision, because in their world, waiting means reacting late. They aim to be ahead of the curve, and their collective actions create a current in the market that smaller traders can either resist and drown in, or learn to ride. This is why monitoring positioning matters more than opinions. It is not about asking whether the Fed will cut or not. It is about observing how the largest market movers are aligning themselves. Their actions reveal where the real probability lies, not the talking heads on financial television. The footprints left in the options market, the subtle shifts in yield spreads, and the sectoral flows in equities all tell a story of preparation. Traders who train themselves to detect these patterns gain a critical edge. Those who ignore them walk into September 16-17 blindfolded, unaware that the strike has already been planned by the biggest hands in the game. Every trader who approaches the September 16-17, 2025 Federal Reserve meeting must recognize that the markets are not a place of certainty, but of probability. The trading mindset thrives on this understanding. No one knows for sure whether the Fed will cut rates, hold steady, or even signal a more hawkish stance. But what traders can know, and what the big players live and breathe, is the probability that the market assigns to each outcome. This is not gambling. It is the calculated reading of futures markets, options pricing, and volatility signals that quantify the odds long before the announcement takes place. The federal funds futures market is the primary barometer. Here, traders are not simply guessing the outcome of the Fed meeting. They are putting real money on the line to express their expectations. Every tick in the futures contracts reflects the collective probabilities the market assigns to a cut or a hold. When those futures price in a 70% chance of a cut, that number becomes the anchor around which strategies form. The retail trader who ignores this data is trading in the dark, while the trader who studies the probabilities sees the battlefield with clarity. But it does not stop there. Options markets add another layer of depth to this game. Institutional traders use options not only to hedge risk, but also to speculate on volatility itself. The implied volatility baked into options premiums before a Fed meeting is one of the clearest indicators of how uncertain the market feels. If option premiums spike, it signals that traders expect big swings regardless of direction. A savvy trader knows that implied volatility is not about prediction. It is about preparation. When volatility is high, the market is bracing for a storm, and that creates opportunities for those who know how to position themselves accordingly. The probability game extends beyond simple binary outcomes. It is not just about whether the Fed cuts or holds. It is about the size of the move and the tone of the message. Will it be a modest 25 basis point cut designed to ease pressure gently? A shock 50 basis point slash meant to signal panic? Each scenario carries its own probability, and the pricing across different maturities in the yield curve reflects those expectations. Traders who analyze the shape of the curve can see where the market believes policy is heading, not only in September but months beyond. That forward curve becomes a roadmap for probabilities stretched across time. For equities, the probability game reveals itself in sector positioning. If probabilities tilt heavily toward a cut, growth stocks often rally in anticipation, while defensive sectors may lag. But if the odds shift toward a hawkish hold, the opposite unfolds. The market rotates capital not based on certainty, but on the probabilities priced into the system. A trader with the right mindset does not fight these flows. They follow them, knowing that probabilities shape the decisions of funds managing billions. It is also important to understand that probabilities are not static. They evolve as new data enters the market. A surprising inflation report, a weak jobs number, or a geopolitical flare-up can shift probabilities dramatically, sometimes overnight. This is why professionals treat the weeks leading up to a Fed meeting as a chess game, adjusting their positioning constantly as the odds evolve. The trading mindset must adapt in real time, never locking into one outcome, but always recalibrating based on the market's shifting assessment. Volatility indexes, such as the VIX, add another dimension to this framework. These instruments quantify the fear or complacency embedded in equity markets. Before a major Fed event, the VIX often rises, not because traders know what will happen, but because they know uncertainty is approaching. This rise in fear pricing is not a sign to panic. It is a sign to prepare. To the trained trader, elevated volatility means opportunities for asymmetric risk-reward setups, where one well-timed trade can deliver outsized returns relative to the risk taken. The probability game also contains psychological traps. Many retail traders fall into the habit of interpreting probabilities as certainties. If the market assigns a 70% chance of a cut, they assume it is guaranteed. But probabilities are not guarantees. That remaining 30% matters, and it is often in that space of improbability where the most explosive moves occur. The professional trader respects the minority scenario, hedging against it or even positioning to profit from it. The market punishes those who confuse probability with certainty, but it rewards those who respect both the likely and the unlikely. This mindset transforms how one reacts to the announcement itself. By the time Powell speaks, the market has already priced in the base case. If a cut was 70% priced in, and the Fed delivers exactly that, the market may not rally as retail expects. The reaction depends on whether the actual event matches, exceeds, or disappoints the probabilities already embedded in prices. That is why many traders say it is not the news that moves markets, but the gap between expectation and reality. The probability game, therefore, is not about making bold predictions, but about aligning trades with what the market has already implied. It is about seeing the invisible hand of collective expectation and navigating it with discipline. Every futures contract, every options premium, every yield curve twist, and every volatility spike is a clue. The trader who learns to read these clues does not gamble on September. They play the probability game with precision, knowing that markets move not on certainty, but on the weight of probabilities priced in long before the decision arrives. When the Federal Reserve sits down on September 17, 2025 to decide the path of interest rates, the decision will not just echo in the bond market or the S&P 500. It will ripple through every corner of global finance like falling dominoes. The trading mindset sees the Fed not as an isolated actor, but as the first tile in a long line of interconnected markets, each one knocking into the next. A single shift in policy reverberates into currencies, commodities, equities, real estate, and even emerging assets like crypto. To ignore this domino effect is to watch only one piece of the puzzle while the entire structure is being rearranged around you. The most immediate and obvious impact lands in the bond market. The Fed's rate decisions directly alter yields, and yields are the foundation upon which so much of global finance rests. If the Fed cuts rates, Treasury yields typically fall, making borrowing cheaper and altering the risk-free rate that underpins everything from stock valuations to mortgage costs. But this move does not stop with Treasury. Corporate bonds reprice, municipal bonds adjust, and even junk bonds catch the shockwave. Traders with a bond desk view already know this. But equity traders who ignore yield moves are often caught off guard when valuations suddenly expand or compress because the discount rate has shifted. From bonds, the effect spreads into equities. Different sectors do not respond in uniform fashion. Technology stocks, which rely heavily on the valuation of future cash flows, tend to rally when rates drop because lower yields mean future profits are worth more in present terms. Real estate investment trusts, deeply tied to the cost of borrowing, also thrive under a rate cut. Yet banks and financial institutions may take the opposite path as their net interest margins shrink when lending rates compress. This rotation creates a battlefield within equities themselves, where money flows aggressively into winners and drains from losers. A trader with a broad equity lens must understand that the Fed's move will not lift all boats equally. It creates sharp divergences, and those divergences are opportunities. Commodities feel the impact as well, often in ways that surprise those who fail to connect the dots. A rate cut tends to weaken the US dollar, as lower yields reduce the appeal of holding dollar-denominated assets, since commodities like oil, gold, and copper are priced globally in dollars. A weaker greenback often drives their prices higher. Gold, in particular, becomes the safe haven play when the market interprets a cut as a sign of economic weakness. Oil, on the other hand, reacts both to the dollar move and to the implications for global growth. If the Fed is cutting because of economic fragility, Oil demand expectations may fall even as dollar weakness pushes prices up. Traders who understand this duality can position themselves with more nuance than those who simply expect commodities to move in a straight line. Currencies are one of the first dominoes to topple when Fed policy shifts. A rate cut narrows the interest rate differential between the dollar and other currencies. That differential is the lifeblood of forex trading, and when it changes, massive capital flows are set in motion. The euro, the yen, the pound, and a host of emerging market currencies all adjust to the new dollar reality. Hedge funds and central banks alike reposition as they anticipate how the Fed's move will alter carry trade dynamics, capital inflows, and reserve strategies. A trader who ignores forex during a Fed week ignores the very battlefield where global capital shifts its footing. The domino effect does not end there. Real estate markets, both residential and commercial, absorb the changes in borrowing costs. A rate cut lowers mortgage rates, often sparking demand in housing, but it also signals caution about the broader economy. For institutional investors holding REITs or direct property exposures, the implications are twofold: cheaper financing, but also potentially weaker tenants if the economy is faltering. This dual dynamic makes real estate one of the more complex dominoes in the chain, one that requires careful reading rather than blind optimism. Even crypto, the youngest of the major asset classes, feels the Fed's hand. Bitcoin and other digital assets have increasingly behaved like high beta plays on liquidity conditions. When rates are high and liquidity is tight, crypto suffers as speculative flows dry up. When the Fed signals easing, money often seeks higher yielding or riskier avenues, and crypto markets respond with surges of speculative capital. To the untrained eye, these moves look disconnected from traditional finance. To the trading mindset, they are part of the same domino sequence, a reflection of the global hunt for yield and risk. What ties all these markets together is liquidity. The Fed is the ultimate supplier of liquidity, and when it loosens or tightens, every asset that depends on capital flows reacts. Traders must therefore expand their vision beyond the narrow lane of their preferred instrument. It is not enough to trade equities without watching bonds, or to focus on forex without considering commodities. The domino effect means that no market exists in isolation. A disciplined trader prepares for this by mapping correlations, tracking intermarket flows, and understanding where capital is likely to rotate once the first domino falls on September 6th. The domino effect across assets is not only about connections, it is about timing. Some markets react instantly. Others take hours, days, or weeks to fully digest the Fed's move. Bonds might swing within seconds, equities within minutes, currencies within hours, and real estate over months. The trading mindset respects this lag, knowing that opportunities exist not just in the initial shock, but in the second and third waves that roll through the system. Watching for these staggered reactions is how professionals extract value long after the headline has passed. Every Federal Reserve meeting brings not only policy changes and data-driven decisions, but also a wave of human emotion that sweeps through the markets. September 16, 2025 will be no different. While traders often claim to operate with rationality, the truth is that markets are driven as much by perception and psychology as they are by numbers and charts. The trading mindset recognizes that the Fed meeting is not just about what is decided, but about how the market interprets and reacts to it. Within that interpretation lies the psychological trap that captures so many traders, pulling them into positions they never intended to hold, driven by fear, greed, and the illusion of certainty. At the core of this trap is the initial knee-jerk reaction to the Fed's announcement. When Powell speaks or when the policy statement is released, markets often surge in one direction. A dovish cut may spark an immediate rally in equities, a sharp drop in bond yields, and a weakening of the dollar. Retail traders, glued to the headlines, rush in with excitement, chasing the move. Yet the trading mindset knows this first reaction is often a head fake. Institutions and large players use the moment of euphoria to unload positions into the surge, creating liquidity by selling to those who are buying in blind enthusiasm. The result is a swift reversal that leaves the latecomers trapped, buying at the highs while the professionals exit with profits. The opposite dynamic plays out on the hawkish side. A surprising signal that the Fed intends to keep rates higher for longer may trigger panic selling. Retail accounts dump equities, bonds spike in yield, and fear races through the market. But to the seasoned this panic often represents opportunity. Smart money steps in quietly, accumulating assets at discounted prices while the emotional crowd capitulates. By the time the dust settles, The initial sell-off proves to have been a trap, engineered by psychology rather than fundamentals. The psychological trap is not limited to the day of the announcement. It extends into the narrative spun in the days leading up to and after the meeting. Financial media thrives on exaggeration, amplifying every possible interpretation of what the Fed might do. Analysts debate endlessly about whether a 25 basis point cut signals caution or panic, whether the wording of closely monitoring implies another move in the pipeline, or whether a higher for longer stance is truly credible. Traders who get caught up in this noise lose focus on what matters most: price action and probabilities. They anchor themselves to opinions rather than evidence, and in doing so, they hand over their decision-making to narratives designed to provoke emotion. The trading mindset understands that discipline is the antidote to psychological traps. Discipline means entering the meeting with a plan already set, knowing your entry levels, your exit levels, and the maximum risk you will tolerate. It means refusing to chase price after an announcement because you know that the first move is rarely the lasting one. It also means resisting the temptation to overtrade, a common mistake when volatility spikes. The market will always provide more opportunities. You do not need to catch every tick during the chaos of a Fed week. Another dimension of the psychological trap lies in confirmation bias. Traders often approach the Fed meeting with a pre-existing belief. If they expect a cut, they interpret every signal as confirming that outcome. If they expect a hold, they dismiss any evidence to the contrary. This bias clouds judgment, causing traders to see what they want to see rather than what is actually unfolding. The danger is not just missing the trade, but actively losing by doubling down on a flawed thesis. The professional mindset counters this by remaining flexible, willing to change perspective the moment the evidence shifts. Markets reward adaptability, not stubbornness. One of the most subtle traps is the illusion of certainty created by probabilities. When markets price in a 70% chance of a rate cut, many traders behave as if that outcome is guaranteed. They build positions that only make sense if the cut occurs, ignoring the very real 30% chance that it does not. When the improbable happens, the reaction is explosive, and those who believed certainty existed are left devastated. The trading mindset never confuses probability with inevitability. It respects the minority outcomes and protects against them, either through hedges or disciplined position sizing. Even after the decision, the psychological battle continues. Traders must contend with second guessing, the fear of missing out, and the temptation to revenge trade. If they miss the initial move, they often chase the market at a worse level, compounding their mistake. If they take a loss, they may try to immediately win it back, entering reckless trades that have no basis in strategy. This is how traders spiral, not because of the Fed's decision itself, but because of their inability to master their own minds. The professionals, by contrast, remain calm, waiting for high probability setups to reveal themselves in the aftermath, when the noise has quieted and direction becomes clearer. Ultimately, the psychological trap around the Fed is a reflection of human nature in markets. People crave certainty, they react emotionally to authority figures, and they fear missing opportunities. The Fed meeting amplifies all of these tendencies, creating an environment where discipline and patience are tested more than technical skill. The traders who succeed are those who recognize the trap for what it is: an illusion built on emotion. They prepare not only for the market's moves, but also for their own psychological responses, ensuring they remain grounded when others lose control. When the Federal Reserve prepares to release its decision on September 17, 2025, the market does not simply sit back and react passively. The largest players already have a strike plan mapped out. This plan is not created on the day of the announcement but carefully crafted in the weeks leading up to the event, refined through observation of positioning, sentiment, and liquidity. The trading mindset understands that institutions do not just bet on direction. They engineer the battlefield itself, targeting specific zones of liquidity where their actions will have the greatest impact. To trade without recognizing this plan is to step into a war zone without knowing where the traps are laid. Liquidity is the first and most crucial element of the strike plan. Large players cannot enter or exit positions at random. They must find pools of liquidity deep enough to absorb their size. These pools often form around obvious levels: round numbers like 5,000 on the S&P, psychological benchmarks on treasury yields, or key forex levels such as parity and URUSD. Retail traders place stop-loss orders at these levels. Option contracts cluster around them, and headlines reinforce their importance. Institutions know this and they plan their strikes around these predictable zones, triggering stop runs that unleash liquidity they can exploit. The strike plan also revolves around options markets. The expiration dates around the Fed meeting become loaded with open interest as traders speculate on potential outcomes. Institutions use this to their advantage, steering price action toward levels where the maximum number of options expire worthless, known as max pain. This dynamic ensures that retail traders holding out of the money calls or puts see their contracts expire with no value, while institutions reap the rewards of controlling the flows. By engineering price toward these levels, the big players reduce their risk and harvest profits, often leaving the majority of smaller traders wondering how the market always seems to move against them at critical moments. Timing is another weapon in the strike plan. The Fed decision may be released at 2 p.m. Eastern Time, but the real games unfold in the minutes and hours that follow. Institutions wait for the knee-jerk reaction to exhaust itself before striking, using the volatility to disguise their true intentions. If the market surges upward on dovish language, they may dump into that strength, using the buying frenzy of retail traders as cover. If the market plunges on hawkish signals, they may absorb the panic selling, building positions quietly while the crowd capitulates. The strike is rarely about the initial move. It is about exploiting the aftermath when liquidity is richest. Another layer of the strike plan lies in cross-asset positioning. Large funds do not think in silos. A rate cut is not just about equities, it reverberates through bonds, currencies, commodities, and even crypto. Institutions create hedge strike plans where a loss in one market is offset by gains in another. For example, a surge in equities after a cut may be paired with a weakening dollar, which boosts commodities. A sharp rise in treasuries can be balanced with equity short exposure. By planning across markets, institutions ensure they capture the movement wherever it manifests, while smaller traders focused on a single chart are left vulnerable. Deception is a hallmark of the strike plan. Institutions often create false signals to lure traders into the wrong direction. They may push prices aggressively in one direction, triggering breakout trades from retail accounts, only to reverse the move violently once the liquidity is captured. This stop hunting tactic is not random chaos. It is deliberate execution. The strike plan thrives on the emotional impulses of the crowd, using fear and greed as fuel. Traders who chase breakouts without discipline become the liquidity that funds the strategies of larger players. Preparation is the final piece of the strike plan, and it is where the trading mindset must mirror institutional thinking. Big players enter the Fed week with defined entry and exit levels, mapped out scenarios for both dovish and hawkish outcomes, and clear risk controls. They are not scrambling to interpret Powell's words in real time. They already know how they will react to each possible scenario. This preparation ensures that when the announcement comes, they act decisively while others hesitate. The market rewards decisiveness backed by planning, and it punishes hesitation driven by emotion. The strike plan is not about predicting what the Fed will do. It is about knowing how the market will respond to what the Fed does, and more importantly, how institutions will weaponize that response. For traders who adopt the same mindset, September 17, 2025 is not just a meeting date on the calendar, it is a battleground with pre-marked targets, liquidity traps, and engineered outcomes. Those who step in without a plan become part of the liquidity. Those who recognize the strike plan gain the chance to ride alongside the largest and most calculated players in the game,